Hi, I'm Lynn Adams.
I'm Justin Gross.
Thank you for joining us for this edition of Video Insight. This is a first quarter market update for 2022. We thought it might be a good idea to get everybody connected to a short video just to give everyone an update on some things happening in the markets, happening in terms of our portfolio adjustments, a lot of activity going on. I guess to set the stage, let's talk a little bit about last year, sort of what happened as we got into the last part of 2021. We got a lot of stimulus from the government last year, so there was a lot of cash running around. The economy got overheated a bit, so bonds ended up finishing negative as rates were rising. At the same time, stocks had a pretty good year last year, and we participated pretty much even with the market in regards to expected returns there. But at the very end of the year, I kind of felt like valuations had gotten a little high, mostly because people were projecting growth forward based on the same level of recovery we saw last year. So from a standpoint of year-end decisions, I think we decided to wait on, for example, reinvesting capital gains that came at the end of the year, looking for a better entry point. Let's talk about now. Market's down 10%, S&P
10%, maybe a 15% top to bottom drawdown, and really that's the reason we wanted to come to you today, kind of mid-quarter. These are usually at the end of the quarter, but these are horrific things you're seeing on TV and real human, just atrocities. I mean, it's awful stuff. So it's so easy to get caught up in the emotions of what you're seeing. It's hit me, I know emotionally, but we have to separate this from our investment management and the decisions we make here. So it's really kind of why we're coming to you live today.
Yeah, so we've seen the markets pull back. Obviously, even prior to the Ukraine situation, we knew that inflation was running really hot in the U.S. We talked about it in our fall symposium. The Fed has really said, hey, we're gonna raise rates, we're gonna slow the economy, we're gonna make this inflationary problem get better, which means that it's a headwind for stocks, it's a headwind for bonds for sure. Let's talk a little bit about the tactical adjustments that we are making in portfolios, because there's a lot of people talking about headlines and markets, but what are we doing with our client portfolios? So one thing I can think of, as I said, we waited to reinvest capital gains monies from the end of the year, thinking that we might get a lower entry point for reinvestment. That's one piece. Maybe let's talk a little bit about in the bond side of things, like what we've done there. I know, for example, we've been systematically removing more bonds that are high quality, government based. Those are the bonds that get hit when interest rates go up, and replacing them with inflation type bonds. We're getting ready to send out to some folks some forms to maybe add an additional piece of fixed income to be more real estate income versus fixed income. On the stock side, we are risk off at this point. You want to walk everybody through kind of what that means? It hasn't heard that before.
Yeah, so from our tactical, like there's core beliefs, right? And in the long run, stocks go up. There's not a long-term stock market chart that doesn't go up from left to right. So we want to be invested. But for a tactical piece, and most of you know what we're talking about here, it's a trend following based system. And that system is really designed to avoid large drawdowns. When I say large, I'm talking 25, 30, 40, 50% drawdowns. Those are the ones that are most negatively impactful to your long-term plans. They're not necessarily designed, you can get lucky, but they're not designed to miss a 10% drawdown. Right. They can if you get lucky, like I said, if the mathematics and the work out just right. But when you're in an elevated upward trajectory, there's typically a fall before those risk off measures kick in, and that's kind of where we're at right now. So we've caught some of this downturn, but if this progresses and materializes into a worse drawdown for the markets, we are risk off at this point primarily.
Yeah, so that's not necessarily like all of the stocks, like more aggressive clients, maybe that's pertaining to half of your stock exposure. For moderate to conservative clients, it might be all of your stock exposure. There's sort of a spectrum.
Yeah.
The more aggressive you are in your account strategy, the less risk on, risk off we use. And the more conservative that you are, the more of the equities that you own, the stocks that you own, would be subject to the risk on, risk off process. But I do think it's important to note, especially as this Russian-Ukrainian thing is really horrific and everybody's sort of feeling like we're going to respond to it or we should respond to it or so on and so forth. Those emotions, they play on investor confidence, they play on consumer confidence. And so I think just knowing that we're risk off at this point puts us in a position where if the market did have a minus 20, 30, 40, 50, 60 from here, we wouldn't participate nearly to the same degree as the overall market.
I mean, we sent out a piece a week or so ago before the actual invasion, talking about some historical precedents for other wars, conflicts. I think maybe what's a little bit different in this one, this is what I've heard called to the first TikTok war. It's live, in your face, social media. You're seeing some of this stuff that you didn't see in other wars. But just to go through real quick, World War I from 14 to 18, the market during that time was actually up 43%. Markets are resilient. That was a long time ago, but World War II, 39 to 45, market up 50%. Korean War, 50 to 53, the market was up 60% over that time frame. Vietnam, 65 to 73, market up 43. Cuban Missile Crisis, that was a short but scary, right? 13 days, but the market finished up 10% that year. 9/11 was a quick 15% drawdown, horrific images that we remember, but the market recovered within months. And so we know that I think the biggest risk right now that an investor would have is seeing these things, getting bubbled up with emotions, which is so easy to do, reacting and saying this one's different, this is the end, this is whatever you want to call it, and derailing your future. Have a plan in place. We've got a plan in place. We're executing that plan, and that's kind of where we're at.
Yeah, I think one of the things that is sort of a good working hypothesis around why historically war times haven't necessarily been terrible for markets is that despite the terrible brutality and things that happen in war, there is a lot of things that come from that, whether it's military spending, whether it's redevelopment spending, whether it's gear and supplies, whether it's people having to be shipped all around the world, and there's spending happening. And so there are companies that their price, the value of the goods or services or whatnot that they provide goes up. We've already seen that in the last 2 weeks where military supplier companies, their stocks have gone up. We've seen people that are in the cybersecurity world, their stocks have been rising. But there's also negatives. There's also companies that are very terribly hurt. I imagine, for example, companies that specialize in international vacation planning are probably going to have a rough go here for a little while. So there are winners and losers, but overall, you have to distinctively carry the hat of let's look at the math and the numbers behind earnings and what companies are being profitable and making money and providing services that are needed. And on the other side is the emotional. Again, this is really horrible. It's a terrible thing to see. How do we deal with it socially, economically, spiritually, all those things? But in our view, I think one thing that we can agree on is that it will cause heightened volatility. Day to day, you'll see things and it may have implications. I think that the Federal Reserve's actions in regards to their rate of increasing interest rates and the input that has to prices of stocks for earnings because companies borrow money to grow, the impact that it has on the real estate market because obviously most real estate is leveraged, it's financed at a particular interest rate. If rates go up, it costs more. I think that's actually the real economic driver, but the decisions that the Fed may make may get put on hold or put into a temporary suspension based on the uncertainty coming on with Europe. We are also risk off international. So, again, for our more conservative or even moderate to conservative investors, that means we don't own any international at all right now. More of aggressive clients and more aggressive strategies have a little bit in international. I do think we could see some more wilder gyrations of returns overseas, particularly in Europe, with some of the things that could cascade from this war. So I just wanted to give everybody sort of an update. I know there's lots of questions. We want to make sure that your individual response to what you're seeing, not just on TV, but in valuations. You're going to get your statements. They're going to be less this month than they were last month. That's just part of volatility. It's a normal part of long-term investing. If that is giving you anxiety more than just unpleasantness, because we always like to get positive statements every quarter, but if it's really giving you anxiety, it's really important that you call your advisor soon. I would rather make adjustments to bring risk down for folks that are having anxiety now when we're 10 or 15% from an all-time high, rather than if we get to be 20 or 30 or 40% from an all-time high. You don't want to make big decisions about changing your risk preferences when things are really suppressed or in beaten down conditions. But your individual anxiety level is an important factor in all of the financial planning process. As far as looking forward, I think that one of our risk off positions tends to actually capitalize on volatility. I think if we get really wild cycles of volatility, we may actually have better results than one might imagine, because we do have a position that actually makes money on volatility.
Yeah, I mean, it's not promised, but in the midst of chaos, there can be tremendous opportunity. And if volatility, the fear gauge, so to speak, were to spike, we do have positions that could benefit from that. If this does boil over into a more dramatic market downturn, from the tactical perspective, risk managed, that can be a tremendous opportunity.
Right.
The more it goes down, it's no different. I explained it as getting a coupon in the mail. You'd rather get a 40 or 50% off discount than a 10% discount. Right. So if that does happen, now that also means that your account in whole, typically for most clients, would go down some.
Right.
But if you're defending capital and you have that capital available to reinvest at a lower price, that could be a really good thing longer term.
So in all of these accounts that we're risk off on, we have dry powder. You have dry powder right now. And if this becomes a prolonged event and the market prices decline for months or even a year, maybe even 2 years, we don't know how long this could happen, but that money that's in dry powder at some point we'll redeploy it. Typically it's once the market finds a bottom and kind of moves back above its 200-day moving average. But that can actually add value, substantial value, to your long-term performance if this ends up being a more prolonged decline. Also encourage everyone that's dollar cost averaging, whether you're putting money in your 401k plans, whether you have a set plan, doing something through less, even if you're adding to regularly. When you get this kind of volatility, this is where those accounts are of huge benefit. So if you have extra income or extra investable dollars that you can increase your monthly investments while prices are moving up and down, every time they go down, you get more shares in that particular month or that quarter than you did when they were at higher prices. And it may not make life-changing impacts, but it's very, very helpful to have something that you're dollar cost averaging into when volatility spikes up. So I think that's kind of some of the more conceptual things. We want to kind of connect what's going on in the world to what we're doing. I'll leave you with the fact that, everyone has certain thresholds of pain tolerance, I'll call it. Even the most studious, disciplined investors, there's probably some level of sell-off that would really make us test our soul almost, right? Can I really handle this? I don't necessarily think we're going to get into ranges that makes people test their resolve to be invested for the long run. But I do feel like that only the client can individually judge your personal anxiety level when you see negative returns. And if you feel like that you're approaching, or that you could approach a point where you want to be more conservative, it is so much better to know that right now than some point in the future where we could be down. A typical market sell-off in a large-scale economic correction or recession is a 40, 50, 60%. We're at 10. So it better make adjustments now if you think that this is causing you mental anxiety. For those of you that are like, hey, this is for long term, I'm in it for the long run, it doesn't really bother me, I think those situations, you probably are exactly where you need to be.
Yeah, this has been like I said, a scary, ugly episode in history. But put in bigger perspective, and we talk about this stat all the time, the normal average, just run-of-the-mill average drawdown year to year is almost 15%. So this is not, you know, a normal event, but as far as market drawdowns, just math, this is a normal market event. And then the biggest thing I think that you just touched on is the difference in risk tolerance and risk capacity. Risk tolerance is a personal thing. How do you feel? Risk capacity, as we've helped you calculate probably, is a plan design. How much can your situation withstand? And that's what really matters.
Before you mess up.
Before you let the emotional override the rational, right? And that's what really matters. That's what you're going to live out in retirement or whatever you're planning for. That's the goals that we hope to put, you know, in motion.
So, well, that's really all we've got for today. We wanted to just put something out there for you that connects what's going on in the world, what we're doing, to where your accounts are. Let's keep communicating. If you have questions, if you have concerns, heck, just send us an email and say, hey, I'm good. I got this. This all makes sense. I mean, let's communicate, because anytime the world gets crazy, good communications is how a great advisor and a great client relationship really make great strides together. So we want to keep that going. We appreciate you taking out a few minutes of your day to watch this, and we're going to read through our disclosures. These are the views of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 Index is an unmanaged index representing the 500 largest companies in America. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Past performance does not guarantee future results.